So this video is going to be very math heavy. I'm just letting you know ahead of time because I've been asked multiple times this week, why pay interest on a line of credit? Why am I paying more money now? Because I don't understand the advantage of this. So we're going to break this down so you can actually see the results of what is happening. So I'm going to pull up a spreadsheet. This is close to an example of one client. All right. So the interest rate actually is a little bit low versus what they have, but it really does not matter. If I put in a higher interest rate, the effect would be even greater. But what we want to understand is there's a mortgage amount of $560,000, 5.5% today would be very, very aggressive and pretty impressive, actually. All right. But here's what we need to understand. This payment is $3,180 a month. Only $600 of this goes towards pushing the balance of the debt down. The rest is interest. So let's just call it a $3,000 payment, 80% of it is interest. 80% of your payment is not helping you in regards to paying down your house. And so here's trick number one. If you want to make a 30-year mortgage become a 15-year mortgage, on the first payment, add $615 more to that payment, because then it will cancel out the second month and jump to month number 3. And when you get here, you add $620 of principal to month number 3, and then that will help you jump to number 5. That's how you can make a 30-year mortgage turn into a 15. But let's pretend that we have this mortgage and we have access to a line of credit, whether it's a home equity line of credit, even though this is a brand new, quote unquote, a brand new mortgage, or you have a personal line of credit. I really don't care. It doesn't matter. And again, the interest rate isn't going to matter because we're going to be using such small chunks at a time. But here's what we're going to do. We're going to pretend our income is $15,000 a month. This is, again, this is what hits our checking account. After taxes, after 401k, after medical insurance, this is what we have for everything else. And our total expenses, including this $3,200 monthly mortgage payment, is $10,500. Now, I've shown before, we're going to use the line of credit as our checking account. But here's what we're going to do, because we're like, I want to jump down this installment loan, jump faster. So let's say we're going to make an extra payment of $15,000. So now that jumps us from $559-ish down to $543. So the first thing we need to do to understand, does this make sense, is to say, well, how long would it take to get to $543,000? So we're here at month number 2, and we're just going to scroll down until we find $543,000 right about here, month 25. So this would take us 22 months of payments to get to the same place as putting a $15,000 chunk right on our mortgage at month number 2. Now you can also say, well, how much interest would that be over the 22 months here? Well, we look here, I'm going to highlight this, and let's just call it $2,500 per month of interest to make this super easy. So $2,500 a month just in interest times 22 months, we would be paying $55,000 in interest to the bank over those 22 months, which we now have eliminated by one $15,000 payment. Okay, now, where did we get the $15,000 from? We got it from our other sheet here, our line of credit. Now, as you see here, I have this at 9%, and I have this increasing every 4 months. So this is working against us. I'm not going to play the whole game out. But here's our first $15,000 chunk we took out of the line of credit, and now we put it against the mortgage. So that's where this money moves. So now we have this $15,000 debt inside the line of credit. Now, remember how we play the game. 15, our entire check goes into the line of credit. And then when it's time for the expenses, the credit card, the gas, utilities, membership, subscription, whatever it is, we take those expenses out of the line to pay those off. But the excess, in this case, the $4,500 stays inside the line to pay the line of credit down. So we can see month one, we end up at 10,614. Why is it not 4,500? Because there's interest of $114. Only $114 in month one. Well, what do we do in month two? We get 15, we have expenses of 10,500. The ending balance is $6,200. The amount of interest we just paid is $81. And you can see by month three, we've nearly paid this off. So we took a $15,000 chunk. We saved 22 months of payments on the mortgage, and it only took us 3 months here. We just saved $55,000 of interest, and it cost us about $250. Does it make sense to pay $250 over 3 months today to save $55,000 in interest over the next 22 months? That's the question you want to ask. That's the results that occurs when you understand the math behind this. And if you want more information, type the word results in the comments below. So let's do this again. Let's go back to the mortgage payment, because now we see in August, we've paid this off. We have a negative number here. Well, in August, let's do another $15,000 chunk. And what happens? That goes down to $526,000. We're here in month number 6. How long would it take to get down to $526,000 if we never did that? Down to about month 26, right here. So it would have taken us 20 months to get there. 20 months at, let's call it $2,450 a month-ish. That is $49,000 of interest that we can now keep for ourselves by doing another $15,000 chunk. And if we did not do these two $15,000 chunks, it would have taken us roughly 4 years to get to that point. And it would have cost us over $100,000 in interest. And instead, now in 6 months, we have just paid off $30,000 of this debt. But again, this is round 2. Where did we get this $15,000 from? We got it from the line of credit. Remember, these are our monthly expenses, but now we just took $10,500 for our monthly expenses and another $15,000 chunk out. So our amount borrowed, as it shows here in the column, is not 10,500, but 25,500. And so what happens? The balance goes up, obviously. And then you can see the next month, it comes down. The month after that, it comes down. And 3 months later, we're back at negative. We're back at zero. Well, what did it cost us? $100 the first month, $60 the second month, 27. Let's just call it $200 to do this a second round. So to save 4 years of time, to save $100,000 in interest, it cost us about $450 to utilize the line of credit. This is the math on how you make this work for yourself. This is the math that the banks do not want you to understand, because it is not in their interest, pun intended, for you to understand how to play this game. These are the results that are possible for you. These are the results that the people that I have been helping have been getting. Again, You can type the word results in the comments below if you want to be like my clients who are seeing these results for themselves.